Okay, Sunday, October 9th. We got that week behind us with a big down day on Friday. So, we'll start with rates, but the story doesn't seem to have changed very much from week to week. Same with real estate; it's just not changing from week to week. We get it. Rates are going up. The real estate market is down. There's not enough new every week to make a story out of it, but I'll still present it. But I think we'll skip real estate this week because as I reviewed it, I thought there's no incremental new news in real estate. It's pretty much going on the same trajectory. Same with rates. We know they're moving. I think the bigger story is, when does it end? We're at that point now where we can start thinking about when does it end as opposed to rates are going up. I think we know that. So our money market rates last week all hit new highs, but capital market rates, September 27th was still the high there. FOMC creeping up 24 days. This is the big one here for the near term for FOMC is we get the September minutes in 3 days on Wednesday afternoon. In fact, it's a really big week. Once we get into Wednesday, Thursday, Friday, these are all big risk days. We are still inverted on the 2s and 10s, 39 now to 41. That's 95 days now. So next week we'll make 100 days, 3 months, a little over 3 months that we've had an inverted yield curve. And again, it's the 2Ds, right? Duration and depth, the length of time we are inverted and the depth of the inversion. We are still inverted over 4 different measures of the curve, but any measure against a 3-month is still upward sloping. Big move in the balance sheet last week, and we're going to focus a little more on this week. Not so much the balance sheet, but we're going to look at M, specifically M2. Fed balance sheet ending October 5th, down $38 billion, but we knew that was going to happen because of the September 30th Treasury maturities. Balance sheet is now $8.234 trillion versus $8.272 trillion last week. Throughout the month of October, we know $60 billion in treasuries are going to come off, roughly about 18 to 19 billion in MBS, I think, will come off. So this should drop into the 8.1 region as of the end of October. Rate hikes. November last week, we had almost an even split between 50 and 75. The weight has moved heavily towards the 75 now. Only a 20% chance of a 50, at least by market pricing. 80% at 75. But the year end is interesting. In black, I have last week's weightings. All the weightings have moved towards the lower end. So 4.75 is 23% weighting on that versus 48. 4.5 is up to 62 versus 47. And the 4.25, which was 4.3, almost nobody thought we'd end at 4.25, is gaining some ground at 14.5. This week we have Fed speakers. We got 6 of them, all before the CPI. I think Monday and Tuesday, and I think Wednesday morning we got someone, and that's about it. Then you have the Fed minutes on Wednesday afternoon, and Thursday morning you have CPI. This is going to be a major test of the bottom because we're back pretty much at the bottom right now. Which is high 3,500, low 3,600. I think we're at 3,640 on the index, just a little above the bottom. This CPI report will be a major test of that bottom. If the bottom can hold with that, that's promising. We also have bank earnings coming in on Thursday and Friday. Friday really heavily. We'll look at the who's on deck for earnings this week, and I think the first one to kick it off is Pepsi on Wednesday. And then all the big banks going into Thursday, and Friday's the heavy day. So if you get a CPI, a core CPI that prints hot, along with bank earnings that are, meh, nothing to get excited about, but guidance is downwards. You get this combination, I doubt this bottom holds. I think you could probably see 3,400, maybe even 3,350. by the end of Friday if you get that kind of situation. The best combination, I would think, is for core CPI to come in at expectations or even just slightly below expectations with the banks guiding down, because you don't want to rally. If you get a rally and the market, let's say core does very well and the banks are doing very well, you get a rally, you're going to go 75 and the weight of your rate increases is going to move more towards the 4.75. We're just going to set ourselves up for higher rates. So I think a little of good, a little of bad. I think that's what we need right now is no reason to buy and no reason to sell, which means for everything that sounds good, we should get something that sounds bad where we think, well, I got no reason to go anywhere. And that will end the rate hiking cycle sooner, and we'll all get out of this much, much sooner. So CPI is the big one, by the way. If CPI comes in hot, I don't know if bank earnings can save us here, but it would be nice to see CPI come in, around expectations, maybe even a little lower. And then the banks sort of offsetting that good news with some bad news. So we think, oh, great, but no reason to rally and loosen financial conditions, but no reason to sell off and lose asset value. Real yields all lower for the week. So the September 30th highs on real yields are still in place. Break-even rates increased across all the tenors and the 5-year forward. That is probably reflecting the strong jobs report. I say strong. Let's change that word to positive growth jobs report that we had on Friday at 263 on the establishment survey. I think it's 204 on the household survey. We'll look at it momentarily. So the economy is still adding jobs. So the total aggregate of money that households have from wages to spend went up. They've got more money to spend, and holding the marginal propensity to consume constant, that means there's more spending available, more spending power available in the economy. We're not losing any jobs. The initial claims, September 3rd, 218, September 10th, 208, the 17th was 209, the 24th got revised down to 190, and October 1st came in at 219. That's reflecting most of September. We got that number this week. And I said if we are expecting negative job growth, we'd want to look at the number 300. If you get 4 weeks of 300, the next jobs report you get is going to print negative jobs. Most economists tend to watch 275 as the dividing line. That if you get 4 weeks of 275, the economy will neither grow nor shrink, but pretty much be right around zero. 300 to me seems like a more definitive number to ensure that you're getting negative jobs. Well, we're nowhere near 300. We're about 100,000 away. If we look at the moving average, the 4-week moving average, 2065, we're quite a ways away from being at 300 on a 4-week moving average. So throughout October, we'll watch this, and it'll give us some idea of what we can expect for the November jobs report. So this does give us some information of which we can sort of piece together whether or not we're adding jobs or subtracting jobs. The adjusted National Financial Conditions Index, this is the Chicago Fed that puts this out. It's 1 week delayed, so we have data up till September 30th, not till the end of last week, but we're going in the right direction. We had to go from negative to positive. Positive means, because it's adjusted, it means that financial conditions are tighter than what the economic conditions would dictate. Well, that's exactly where the Fed wants to be. It wants to be in a restrictive stance. If it wanted to be neutral, then this would be very close to zero. You could say, well, that's pretty close to zero as it is, right? But we've gone from, negative 0.09 to 0.05 to 0.08, and with the sell-off we had last week, maybe we're a little tighter than that now. But we're going in the right direction as far as what the Fed would like to see. Okay, let's look at OAS. All of them decreased through the week, but the week here is the Thursday, the ending Thursday. We don't have Friday's compiled data. We won't get that till Monday. We can look at HYG, which is an ETF that tracks high yield, and we can look at how it performed Friday. It was down 1.2% on Friday, but that might have been just from changes in rates as opposed to changes in yields. It might have just reflected the change in the treasury yields, which form part of the spread for high yield shares, without really reflecting too much of the spread itself. But I'm sure there's some spread in there, but we got to wait till Monday on that one. I've been puzzled as to why spreads are not increasing faster than what they are, and I've been listening to some allocators, and these are asset allocators, talking about, the question is always, where do you hide? Because if you're expecting more downside, where do you hide? If you think rates are going higher, it's hard to hide in bonds. If you think the market is going lower, it's hard to hide in equities. So there's the alternative of cash. You can always hide in cash. Because that's paying 4%. Well, it doesn't take much to move from cash to say, well, instead of cash, why don't we just go into high-grade bonds? We can do that. High-grade bonds have a very low default rate, and if you're buying a broad index of high-grade bonds, you're sitting at 5.65%. As opposed to 4% in cash. Why not grab something like that? Even if you go into triple B's, 602. I'd still say, well, going to triple B's, the lower part of high grade, to be in a more balanced portfolio, I'd probably say, well, the 5.65 is enough. And that is, if you take the 1 to 3 year, if you find a 1 to 3 year ETF in high grade bonds, you're probably getting a 5.5 to 5.75 yield, which is probably going to be good. Meaning that the default rate is going to be extremely low, if non-existent, in one of those ETFs. And you're getting that amount. The argument that I've heard against it is, well, you're underperforming inflation. But if you're going to be in equities and face a potential 10% drop, well, 10%, negative 10% underperforms inflation by a hell of a lot more than 5.5% does. So it could be, where do you hide? Well, you hide in cash, and if you're hiding in cash, why not hide in something that is, maybe a little bit riskier, but almost as good as cash, which would be your high-grade bonds. So maybe, when you look at the capital structure, maybe there's a migration because you have debt that sits above equity, right? And then with debt, you have all of the qualities of debt that you have, your investment grade all the way down to high yield. So whatever company you're in, why not migrate up the capital structure into the next best thing in there? It'll be less risky than the equity, obviously, because it's higher in the capital structure, and it may have a yield that's a lot more predictable than the yield on equity. So it could be that the yield on corporates is offering a valid alternative to equities, because we know the TINA trade is dead. There is no alternative. Well, now there is an alternative, which, for some people, if you want no risk, the short end of the curve up to the 1 year is offering 4%, a little over 4% right now. Let me just verify that for you. The 1 year right now, 4.25%. And you're going to get that in 1 year. That's a treasury, a T-bill, and you're going to get that in 1 year. Well, equities have risk. Maybe you'll do better, but maybe you'll do worse. If you're expecting another 10% or 20% downside to equities, suddenly 4.25% guaranteed looks really good. And if you underperform inflation for the year, you would have really underperformed in equities. But you're preserving your capital so that when the market is lower, then you step in a lower market and you outperform inflation over the next few years. The idea of outperforming inflation is not that you are trying to outperform inflation every single day you're in the market. There are times you're going to underperform inflation and times you outperform, and you hope in that the years of outperformance you really outperform. So outperforming inflation is over a longer period of time, not a 30-day period. So the argument that you can go into a 3-month and get 3.5%. Oh, but you're underperforming inflation. That's not the point. That's not the time frame under which you would expect to outperform inflation. It's over a longer period of time. At this point in time, the motivation is preservation of capital as opposed to return on capital. Let's just preserve the capital. You're getting some good competition from corporates, especially in the investment grade sector, maybe at the upper end of the high yield market as well. And treasuries in the money market is offering compelling return. In fact, 4.24 on a 1 year, 3.89 on a 10-year. Why would you not just take the 1 year and then hop back into the market when you think it's going to do well? You can move into a 1 year at 4.24. Duration is so very low. As each day goes by, that T-bill becomes less and less and less sensitive to changes in rates. So even 3 quarters in, 9 months in, you don't have to wait to maturity. You're probably going to be very close to that price yield, on the price yield curve of where of the value that it should be. So with the rates where they are now, yes, the Fed is going to keep pushing rates higher. Money market kind of makes some sense to be there. That is now, I think, at the point where it's giving real competition to equities. Okay, let's look at a few things from Friday's job report. This is household data. It's Table A. The first line gives you the civilian non-institutional population, 172. This is the potential labor force, increased by 172. Then the next line is how much the labor force increased by. It shrunk by 57. So we should expect a drop in the participation rate, and we have it, 62.4 to 62.3. The number of employed people increased by 204,000. There's your jobs number from the household data is 204,000. Let's go down to the establishment data, and the first line is our job creation number, 263. And then we can look for some negative numbers to see where we're shrinking. You have negative 1.1 here in retail trade. You have negative 7.9 in transportation and warehousing. And negative 25,000 coming from government, which is what we want to see. At a time like this, when there is a fight for labor, let the free market have the labor. Government doesn't need to hoard labor at this point. In fact, government could do very good by releasing labor into the market, into a strong job market. Let the private sector pick up that labor. And you're lowering the deficit at the same time because you're still deficit spending. So you're lowering the deficit, which means you're lowering the amount that the debt would rise to, or at least you're decreasing the pressure, the upward pressure on debt. And that debt right now costs the most to finance, is the debt, the new debt that you're issuing right now. So this is actually a good number. That's 25,000 more people that are now available to the private sector. Let's go to Table B, and this is on page 30. If you are interested in industry by industry, Table B is great for you because it breaks it down by every industry that you can get. So we start with goods producing, mining and logging, and some of the sub-industries in here, construction, some of the sub-industries in here. If you're looking for, well, where are jobs being lost and where they're being created, you can just scan down here and look for big positive numbers and big negative numbers. So you have 17.7 here if you come across specialty trade contractors, residential and non-residential, 17.7. Well, we know that there is a shortage of labor for housing construction. Even though the housing market is really turned down, we know there's still a shortage of workers in that sector. So any gains there are looking good. So when you think about that, well, they gained 17.7 in a sector that's shrinking. So what was the labor shortage to begin with? We know that having listened to the conference calls of some of the builders, they are saying that they can't get the houses to market as fast as they can because of these particular things. So this is actually good in a deflationary sense. If we can get more workers in here to get more output out, this actually helps in a deflationary sense. And wherever we see the negative numbers is where jobs are being lost. Let me show you something interesting here. which shouldn't surprise you at all. Let's get down to motor vehicles. Motor vehicle parts and dealers, auto dealers, other motor vehicle dealers. Look at the negative signs that you have down here. If you can't put the vehicles out because you can't make more, because you can't get the parts, then you don't need that many people working for you. So you have job contraction in supply constrained areas. So, which is good, because those people are now available in the free market to other companies that are having trouble finding employees. So there's a lot of interesting stuff in Table B. Depending on what sector, what industry you're interested in, you can get right down to some nice little detail. Okay, let's go to the Federal Reserve Bank of Cleveland. They do inflation nowcasting. We get CPI coming up on Thursday morning. So let's look at where they're sitting for September. They're already starting to nowcast for October. So these numbers will change as data comes in over the month of October. But this is fixed now. This is in the books. This is their forecast for what inflation is going to be. Month over month, 0.32 on headline, which would make that an annual rate of just a little under 4%. If you take 1 month and say, well, what is the 1 year forward based on that 1 month change, you're a little under 4%, but this is not good here. The core at 0.51. So the forecast this Thursday is for headline to come down, to look good, but the core to accelerate. That will not be welcomed by the market. It's a question now of how much the core accelerates. Now, the market is expecting an acceleration in the core, so it's probably already priced in that, well, for as much as we think it can be priced in, maybe Friday's reaction was all about the jobs report, and once we get into Monday and Tuesday, we might start to get nervous about what we're going to expect to see on Thursday. I don't know. 0.51. And we know that the report doesn't like to use 2 decimal places. Thank you, Cleveland Fed, for sticking in 2 decimal places. But what if we get a 0.5 and it's really 0.549, right? Are we going to be excited about that? 1 more decimal place. Really, 1 more. It's not going to kill you. If it comes in at 0.4, that's going to be super bullish. If it comes in at 0.6, I think the bottom that we have right now, I think that bottom is gone. Here is the year over year that they're expecting. This is really backwards looking at an 8.2 on headline year over year and a 6.64. I have seen some forecast printing a 7.9. I've seen an 8.1. Here's an 8.2 and core of 6.64. So we'll see how close they get. We'll take another look at the economic calendar at the end, and we'll see what the forecast is for inflation. Now, there is still, some debate about, well, what type of inflation do we have? If you have demand-driven inflation, well, then the higher interest rates that we're seeing should do something to curtail that type of demand. But if you have supply-driven inflation, higher interest rates aren't going to do it. In fact, higher interest rates could make a bad situation worse. It's hard to see that with the complexity of the economy. So for the next few screens, what I'm going to do is we're going to look at the money supply, we're going to look at velocity, and we're just going to do a couple of thought experiments of, well, what if production increased? What if production decreased? What is the market clearing price under each of those scenarios? And what is the most likely response in terms of unemployment? And by using some simplified examples, and yes, that's economics, right? We want some nice, simple examples. I think that economics gets, criticism that is unwarranted. The criticism being, but the world doesn't work that way. These models are too simple. They only have a few variables. That's the point. You have to tame the complexity of the real world, but out of these simple models, it's not the model. We don't judge it by how well it represents the economy. We judge it by how useful it is for us to come up with conclusions that tames the complexity of the economy. And sometimes looking at simple variables, just the interaction of a few big but simple variables, gives us some idea of the likely outcome that we would have. Okay, before we walk through some of those simple models, let's have a look at where we are right now. Here's the Fed. They are focused on the real economy, labor, goods, and services, specifically employment and inflation in goods and services. You have asset markets. Here we can look for equities, bonds, and real estate. And we know that prices on all of these have been going down. And this I have most likely, likely, and least likely. And that is in terms of where the Fed is going to act. On the economy, most likely they're going to act based on the economy. They're likely to act on the financial system if the financial system is under stress. And when we talk about the financial system, we're talking about credit and liquidity. They are purposely trying to reduce the amount of credit available by raising interest rates, because credit is a form of money creation. They're trying to lower the amount of credit by raising the interest rates. And if you lower the amount of credit, you lower the amount of money creation, you lower the amount of the money supply. Well, then that money isn't available out there to demand goods and services. Liquidity is a problem, right? So if we go to our asset markets, if prices get too low, it may cause stress in the financial system, specifically with liquidity, which is why I say here the Fed is likely to step in if something like that happens. But asset markets getting prices too low, least likely to step in. They're not even focused on the asset markets. They don't even care at this point. They only care about the asset market to the extent that it would create a problem in the financial system. They're likely to step in there, but that does not necessarily mean they're going to lower interest rates. If there is a problem with other central banks around the world, they can open up swap lines to provide dollars if there's a dollar shortage. We'll see a little later on in this video that the reserves, central bank reserves, are dropping quickly as more and more central banks step in to defend their currency. Well, the Fed doesn't have to lower interest rates or buy U.S. treasuries to fix that. If there is a liquidity issue in the treasury market, they can step in to provide some support for just that, but I don't think they're going to be looking at asset prices at all. If prices get too high, especially bond prices get too high, yields get too low, it may encourage the formation of more credit, which would force the Fed to go even further. This is the last thing they want, and we're seeing that with Fed speak. Last week I used the words "no daylight," and all of their speeches are the same. The door to the pivot is closed behind them, and they're not allowing a shred of daylight to slip through that door crack. None. No daylight. So rallies, they're not going to be a big fan of. Rallies will only make it worse because the Fed will have to work even harder, because they will fear that, well, that's going to feed inflation because now you're making credit more available. They want that to end. They may step in if prices get too low, only if it causes stress in the financial system. But as far as a put, I don't see that at all. Okay, let's set the stage for this little thought experiment that we're going to go through. On the screen is money supply, is M2, billions of dollars, not seasonally adjusted. So being that it's not seasonally adjusted, we're not going to use seasonally adjusted GDP, and we're going to use nominal GDP here. So over this period of time, from June of 2014 to we're here the end of 2019, just before 2020 begins, the end of 2019, the money supply grew fairly consistently. You could pretty much draw a straight line across there. Money supply, M2 growth, was 5.73% per year. Nominal GDP grew at 4.03% per year. Nominal GDP at this time was 17,550, and if you take the money supply and you take the beginning of year and end of year balance and divide it by 2 to get an average, because you got a fairly straight line, so you can take an average. It's not as if you have any curvilinear effects going on. You can take an average. You get a velocity of 1.54, and in fact, if you look up velocity, if you chart velocity through Fred, you will find at that point in time velocity was in fact 1.54. If you have money supply growing at 5.73% and nominal GDP only growing at 4.3% over that period of time, the only explanation to get that done is velocity of money is dropping. And we do have velocity of money at 1.42, which is consistent with the chart for velocity. This gets really interesting now. Look at the super big increase we've had in the money supply over here. And we're saying, well, isn't it any surprise we have inflation? But we got a problem. 2021. I'm looking at the money supply at the beginning of 2021, the end of 2021. I think, well, that's kind of a fairly straight line, so I'm going to do a little simple thing rather than do a daily weighted average. Let's just add the two together, divide by 2 to get an average, and divide it by GDP, which is 23,315. Velocity is 1.14. Velocity has dropped significantly. Well, that's not inflationary. That's kind of curious. And here, April 22nd, of 2022, money supply 22,063, and now it's 21,613. So you actually had a decrease in the money supply, and for the last couple of months, you basically had a fixed amount of money supply, neither growing nor shrinking. That has some significant effects, and I think it's important that we understand the role of money supply in the economy. Now, keep in mind here, we had 1.54 in 2014, 1.42 in 2019, 1.14 in 2021. So velocity is dropping. So I want you to think about this for a moment. Let's say that there was a money supply, and we're going to assume the money supply here is fixed at 100. We're just trying to make a simple little economy with a simple little example. That's all we want to do, because we want to see out of that simplicity, can we get some principles out of it that would apply in a more complex system without us having to model the complexity of a complex system. So let's assume the money supply is 100. And you have 10 of that money supply. At the beginning of the year, you take 10 of that 100 and you put it in your pocket all year long. What's the velocity of that 10? 0. So the more money that is sort of just sitting on balance sheets, sitting in pockets, just sitting around doing nothing, that money has a velocity of 0. So if over time, money on balance sheets built up, money that was not available in the economy but was clearly money is simply not available, then it's not available to spend or to buy. It will create no GDP in that sense. It will have a velocity of 0. Now again, keep in mind, I'm just simplifying. We're starting from a simplified example. So let's assume the money supply is 100 and it is fixed with a velocity of 1. And production in the first year is 100 units. The market clearing price would be $1 per unit. And that would clear the market. There'd be no inventory build, and there would be no shortage. You'd clear the market. And let's say that you have some technological advancement or some productivity gains, and you can produce 200 units the next period. It doesn't even have to be productivity gains. You could have hired more people and produced 200 units the next period. But the money supply is fixed. Here's the problem. If you try to keep your price constant at $1 per unit, and we'll assume that the market is made up of a whole bunch of players where none of them have any particular power to control the market. Price is $1 per unit, inventory is going to increase by 100. Or if you want to clear the market, the price is going to be 50 cents per unit because there just isn't enough money. Given the velocity that exists, there isn't enough money changing hands to get a higher price. If you then increase production to 300 units and keep your price at $1, your inventory is going to increase by 200, or you're going to have to lower your price to 33 to clear the market. And again, we're not assuming a monopoly here. We're assuming perfect competition, which means that nobody can control, no one firm can set the price in the market. It's a competitive marketplace and everybody's competing against everyone else. So if output grows with a fixed money supply, it is going to be deflationary. Or if Firms then control their production because you have inventory rising. If they then say, well, okay, we have 100 rise in production, our next period we're not going to produce less, we're going to create unemployment by doing that, you'll have a drop in production. So a fixed money supply with an increasing output will either be deflationary or recessionary, and that is if you keep the velocity of money at 1. Okay. That's not what we have right now. We do have growth. We have slowing growth, but real GDP for the first 2 quarters of this year, if we just take it at face value, was negative. Well, what happens if production is decreasing with a fixed money supply? What will we get? Right here we see this is deflationary. So if we want deflation in a growing economy, what we can do is hold the money supply constant, which is what we've seen going on over this period of time. If we want deflation even faster, let's decrease the money supply. Well, the Fed balance sheet runoff is attempting to do that. We've sort of just said, well, the balance sheet is running off, it's too high anyways, it may cause, liquidity issues in the treasury market without really understanding its impact on prices. Or in equilibrium, what the market clearing price would be in equilibrium. So we can see that this, what they're doing here, has a purpose. It is deflationary if production is increasing. If you have any kind of increasing production, it is deflationary. Let's decrease production because that is more what we have going on, especially in housing right now. You have decreased output, especially in autos, you have decreased output. And the biggest supply constraint right now is in labor. We have a decreased supply of labor and what seems to be a decreasing supply of labor. Okay, again, let's assume that we have a fixed money supply. Velocity is equal to 1. And we have to look at this under 2 conditions. Number 1, full employment. What happens if you maintain full employment? And number 2, what happens if employment adjusts to lower output? So let's start with our baseline. We're producing 100 units. The price will equal 1. That is your market clearing price as a velocity equal to 1. Let's say that output now drops to 90 units, and you can think of this as vehicles, an economy that produces nothing but cars, and that's what we have right now. GM, Ford, Tesla, almost every automaker is building up inventories because it's not as if they're not selling, they're just saying we can't ship these, we're missing parts, so production is dropping. Well, at 90, if we're assuming velocity of 1 and a money supply of 100, the price would rise to $1.11 per unit. That would be your market clearing price because you're creating a shortage, but you still have velocity times your money supply. You still have potential GDP here of 100. To get there, your price is going to have to increase because at full employment, you're creating a shortage, right? Market clearing price at full employment. Let's drop it to 80 units. I'll get to this column in a second. Let's drop it to 80. The market clearing price would now be $1.25 per unit at full employment. Well, that's inflationary. What's going on in housing? What's going on with cars right now? We're seeing that. I have a car. I have a truck. I want a new one. I can't get a new one, so I can't trade mine in. If I can't trade mine in, I take one used car off the market that otherwise would have been there. So the fact that I can't get new vehicles means that used car dealers can't get my used vehicle, and along with everyone else's, so you're creating that shortage. And autos are 8% of the weighted basket for CPI. Housing is 32% between owner's equivalent rent and rent. And we actually have a shortage of housing, and we're making the shortage even worse. Well, look what's going on, right? Look what happens to the price. It is inflationary. Lower output with a constant money supply is inflationary. Before we go on with the white stuff here at the bottom, let's get the blue stuff out of the way and say, well, what if employment adjusts to output? That if output were 100 and it's 90, what if employment adjusts? You saw earlier in the jobs report when we went down to automotive, you saw that they were shedding jobs. Not because they're shrinking due to demand, they're shrinking because they just can't produce more vehicles than what the supply chain allows, so you don't need all those people. So let's say that these are strategic firms that are now anticipating the decline in production and lowering employment ahead of that, which means you're going to have money building up on balance sheets that are just going to sit there. Remember, money in your pocket all year long has zero velocity. So what's going to happen here at 90 units? Well, you're going to have 10 units of the money supply that is going to have zero velocity, and you're going to have 90 units of the money supply that is going to have 1. So the weighted average is 0.9. Velocity drops to 0.9. The price can be maintained at $1 per unit. It is no longer inflationary, but it is not deflationary. It stays at $1 per unit. When you're cutting back on supply, it's either going to have no effect if you cut back employment at the same pace, or is actually going to be inflationary at a constant velocity. If you go to 80 units and you cut back employment again, you can drop velocity to 0.8 and keep your price at $1 per unit. However, if you're keeping your velocity at 1, even with the dropping employment here, velocity is 1, you're going to get both price increase. Those left with jobs are going to say, well, because I have this price increase, I need more wages. And more wages, which means a higher price increase mean more wages. So you could have a situation where you're lowering employment, but you're raising your prices at the same time. And this is called the wage price spiral, which will be recessionary. You get both. You get stagflation. This is precisely what the Fed wants to avoid, would like to avoid that altogether. If they keep the money supply fixed, while this is happening, we know it's inflationary. Now imagine what would happen if you increase the money supply into a supply constraint. It would be really inflationary. So what you have to do is you have to decrease the money supply to take care of the supply side of things. However, we're not seeing this yet. We're not seeing a lot of employment adjusting to output yet. That would be the next step. But this is pretty much what the Fed would like to avoid. Okay, let's change a few things here. This is our last screen, then we can come up with some conclusions here. M equals 100, production equals 100, velocity equals 1. Your market clearing price will be $1. Drop your money supply to 95 because you have had a decrease in the money supply just from April of this year to the end of September. Drop the money supply to 95, but keep your velocity. Let's say velocity doesn't change. Market clearing price will be 0.95. Because the price is lower, it may lead to higher unemployment. And that's a market clearing price if you don't want an inventory build. Again, money supply is at 95, but this time, assume that it did lead to unemployment. Velocity is 0.95, price drops to 0.9025. That is deflationary. So the money supply contracting is one part of it. If you can get unemployment to contract as well, that is the other part of it to get your deflation. So it's deflationary and possibly higher unemployment. We don't know if companies are going to let employees go, because if you have a tight jobs market, you might have labor hoarding. And if you have labor hoarding, this may go on for quite some time. Here's what would happen if you actually increase the money supply, because you have some people saying, this is ridiculous, the Fed is shrinking the money supply. Do you know how bad that's going to be? Well, let's say they increase the money supply and velocity dropped to 0.95. It wouldn't do anything to inflation. You'd simply create unemployment without any change in price, because here's your price, your market clearing price here. Now you've increased the money supply, you've created unemployment, and you haven't done anything to the price. You've basically stayed at the same price. All you've done was create unemployment. So you have to find a way to decrease the money supply, or at least not increase it. Either keep the money supply fixed or decrease the money supply. Every little bit of unemployment will reduce velocity. That will then start putting downward pressure on prices to clear the market. This is a good place to be right here. Right? Is if you have some response to unemployment here, you'll get a velocity of 0.95. Your price, you're down 10% basically on your prices by doing that. A 5% contraction in the money supply a contraction in unemployment. I haven't stated what level of unemployment we have, so we don't know what unemployment rate that would add to. But that would slow down the velocity. That would really have a big effect on prices and possibly higher unemployment. So this is what the Fed is attempting to do over here. With higher rates, it's restricting credit. And we can, and with the runoff of the balance sheet, we can start to look at the money supply to see how much of an effect is this having right now. The combination of all of that, what effect is it having? And if you can keep the money supply fixed and even contract it a little bit, you don't have to necessarily have as much unemployment to get deflation, to work on prices, because the first effect will be on prices. Flat money supply growth with supply constraints, you're going to get inflation plus unemployment. We saw that on the previous screen. That's what the Fed wants to do. Decreasing the money supply will induce deflation. So I would, if I have to predict, I would expect this to keep coming down. And if that keeps going in the right direction, it's going to have a significant effect on prices. It's basically been sideways for the last little while. So, it hasn't had a chance to have much of an effect. But with higher rates, which what we expect going into the end of the year, plus you got 60 billion for sure of runoff in treasuries, maybe about 20 billion in MBS. You got another 80 billion dollars over here. Restrict credit some more over here, and we're already seeing restricted credit in issuance. If you look at bond issuance, the lowest in I think it's something like 20-30 years. It's the lowest, not 20-30 years, since the great financial crisis, the lowest bond issuance from corporations since that period of time. If you look at what banks are reporting in terms of where they're down in revenues, it is in things like issuance, IPO, underwriting. Those things are down significantly. So you are restricting credit, which is restricting money supply growth, even though you have some credit happening. So there is some growth there, not as much as it used to be. And if you're allowing runoff, you are either going sideways or shrinking. Shrinking will cause deflation in prices because we have inflation. You need deflation now, which would give us disinflation. If you have inflation and you combine it with some deflation, you'll get disinflation, which is what we'd like to get down to 2%. The money supply will go a long way to getting that done for us. So let's keep an eye on how the money supply is unfolding, month after month. I think this is weekly. Yeah, we get weekly information here on M2, so we can look at this weekly. Although we don't get GDP weekly, we get it quarterly. So, let's just, so we can't figure out what velocity is, but we can at least keep our eye on the direction of M2. So there's a new variable to add to your screen on a weekly basis. What is going on with M2? If we see decreases in M2, we can then sort of lean more towards inflation coming in lower in future months, because that will constrain the amount of money available. And if you're going to have an equilibrium in markets, you're going to have some kind of inventory clearing price. Well, that will be lower, which is what we need to see. Okay, big news in energy last week. OPEC agrees deep oil production cut, or OPEC Plus agrees to deep oil production cuts. Biden calls it short-sighted. I don't know why it's short-sighted. It is exactly what the U.S. would do if the tables were turned and the U.S. had all the oil. I think it's exactly what they would do. Here's the curve from the forward futures curve. We can see it is in backwardation, and we can see higher levels of prices from 2 weeks ago. This is 1 week ago. In fact, if we look at the December contract, because the December contract expires November 20th, December contract in 1 week is up $13.18 on the December contract. The front month hasn't moved as much. Notice how the November contract is lower, then you have a big jump up to the December contract. And that is because the OPEC cuts, they're going to cut production by 2 million barrels per day starting in November. Well, the November contract expires October 20th. So it's not going to have that cut priced in. But the December contract expires November 20th. So that'll be 20 days into November. So that's why you have that big jump up in the November contract, and then you have the curve slipping down. This is going out like, what, 9 years, 8 years, 9 years. I don't know that there's much information past 12 months. The first part of the curve, I think, is what you want to look at. I think this anomaly over here is just pricing action. Based on where it traded last. It might have just been sort of an outlier on that one. Real cuts are estimated at 1 million barrels per day due to underproduction. So they had a cap, and this is the production cap, and they were producing around here, basically, which is 1 million barrels per day below the cap. So if they had cut production by 1 million a day, it wouldn't do anything because it would just bring the cap down to where production levels are, but they're decreasing it by 2 million. So they're actually making a deep cut of 1 million barrels per day. Biden criticized the decision, calls it short-sighted. Saudi says West's criticism driven by wealth arrogance. Well, again, I don't know if that's true either. Saudi says cuts necessary due to rising interest rates. Well, listen, there is a limited amount of time in which that oil is going to have value. So why let it drop to $60 and $50? Why not use production and supply side management to make sure that you're going to, if you're going to pull oil out of the ground now, with every government having a knife at your throat, every oil producer basically has been put on notice that they're going to be murdered in the streets. Where's the motivation of any of them to do anything else but preserve their own self-interest? So, when you look at something like this, you can't blame the Saudis for doing this. If I were them, I'd say, well, I'm going to do the same thing. What you have to blame is this absolute disregard for any kind of transition to a carbonless future. To say, no, let's do it now. Let me just give you an example of how short-sighted all of that stuff is when we talk about all of the agreements to cut carbon emissions, how absolutely short-sighted it is. Because, I've seen this thing done before where we see some kind of policy and there are policy recommendations that are developed around this particular policy. And after, politicians like to point out, listen, we had experts look at this and here are the recommendations that they gave us. They said if we don't hit these targets and we don't change our energy by these certain dates, we're going to be in trouble. These are experts. These are experts that have set this recommendation. Are you disagreeing with all of these experts? Well, here's the thing. Carbon capture is a very real thing. If you burn a barrel of oil and you release, let's say, 800 pounds of CO2, but at the same time you have a carbon capture facility that draws 800 pounds of CO2 out of the air, you are carbon neutral. What does it matter where it comes from? You are carbon neutral, right? Well, the proponents of carbon capture were not allowed in the room to help set the recommendations. So the policy dictates the type of people allowed in the room to set the recommendations. So you can't just say all the experts say that this is what we have to do when you leave these experts out of the room that cannot set the recommendations. They don't even have a voice at the table. But think about it for a minute. I, as a human, breathe in oxygen and breathe out CO2. However, if I plant 3 trees in my backyard, I am carbon neutral. Well, that's carbon capture. That is a carbon capture technique. I've set up trees to capture carbon. Well, is there a more efficient way than planting trees? Because there's not enough surface on the planet of the Earth to plant enough trees to pull that carbon out of the air. Is there some technology that we can employ that would pull the carbon out of the air, that would occupy less space than 3 trees, and who knows, maybe pull enough carbon out of the air to offset 2 human beings or 3 human beings? Yes, there is. There is carbon capture. It can be done. Carbon capture and sequestration. However, they're not allowed in this room to set the recommendations. So when you have something like this, when you ignore something like this, when you hold a knife to the the fossil fuel industry saying, we don't even want to hear your solutions. You're not even allowed to speak at this point. What do you think they're going to do? Say, hey, what else can we get for you? Can I get you a snack to go with that knife in my back? Come on, man. Seriously. So the idea of calling everybody names, Biden saying that it's short-sighted. No, it's not. No, it's not. Their policy of not allowing these people a voice at the table is short-sighted. That's what it is. Their idea that we can switch over to battery-powered and solar and wind in the next 5 or 10 years, that's short-sighted. Because what are you going to get? You're going to get a squeeze in energy prices. Plain and simple. This is architected or manufactured or engineered. This is created by, I think, sort of a collective ignorance of the possibilities of what could be. Hey, I'm all for reducing the CO2 in the oxygen. I do believe it is the elevated level of greenhouse gases that is causing all of this wild climate stuff we have. But that doesn't mean that there aren't solutions available where you don't have to actually say everybody that's doing this is evil and bad and you're all going to die. Come on, man. Anyways, there we go. U.S. gasoline stocks, look at where they're headed. This is for the last week. This is from the Energy Information Administration. This shaded area is the 5-year average. This is the range. We're way below the range. If you look at oil stocks, this is the middle of the range, the upper end of the range, the lower end of the range. It's at the lower end of the range right now for crude oil stocks. And this is U.S. gasoline stocks. This is just not going to be helpful for headline inflation, because what is going to happen to heating oil, to gasoline? Well, it's going to go up this month. It's going to go up for the month of October, because if you own a petrol station right now, you're going to say, look, my costs are only going to increase in the future. I'm going to increase my price now. And the price is going to increase in November and December unless you find a way to deal with this. But at this point, if I were part of OPEC Plus, I would say, hey, you guys did this to yourselves. You guys did this to yourselves by not letting our people in the room. We have good solutions for carbon capture, and you said we are a distraction. Carbon capture is a distraction. They weren't even allowed in the room. All right, strength of the U.S. dollar. This, I said a couple of weeks ago, this is going to break something somewhere. You just don't know. This is not something that's heading in the right direction. World currency reserves shrink by $1 trillion in record drawdown. Central banks dip into reserves to defend their currencies. Indonesia's forex reserves dropped to 130.8 billion at the end of September. That is still 5.9 months of imports. The cutoff, I don't know who set the cutoff, but I think it's a World Bank or IMF that set a cutoff, said, more than 3 months is good. Anyways, it's more than this number of 3 months, 5.9 months of imports, but it's moving in the wrong direction. South Korea, September FX reserves post second biggest monthly decline on record, down to 416.77 billion. 20 billion to counter low currency, the dropping won over the course of September. Japan's foreign reserves dropped by record on market shakeout and FX intervention. Japan foreign reserves down for 2 straight months. They got a lot, 1.238 trillion reserves, second largest after China. However, the balance that they have now is the lowest since March 2017. Drop in reserves come after last month's currency intervention. Authorities mum on speculation about selling U.S. treasuries. So they used their reserves to defend their currency. They may or may not have sold U.S. treasuries. They're not talking. They never felt a limit to ammunitions for FX intervention. In other words, to intervene in their currency. You can only do it for so long, and Japan is saying, we never felt we had a limit. We don't feel that. Here is U.S. dollar reserves. In Japan Ministry of Finance, the amount of their U.S. dollar reserves. Have a look at that. that is dropping. At some point, they will run out of reserves. This is part of the reserves are their U.S. Treasury holdings, but that's dropping. Once you run out of the actual cash, you have to sell treasuries to get cash to buy your own currency. This 1 trillion, by the way, represents about 8% of global central bank reserves. So it sounds like a lot. 1 trillion in a record drawdown, that's about 8%. The stronger the US dollar gets, the faster this will start to increase until the Fed at some point is going to have to open swap lines to give US dollars to other central banks to continue to do this, which means the US central bank will be building foreign currency reserves while they're supplying US dollars, but they're swap lines, so that all has to be returned at some point. But more US dollar strength is going to become a problem. So one has to wonder, if all of these countries are stepping in to defend their currency while they're buying the US dollar, it's not just their currency that gets the effect of the selling of the US dollar to buy their own currency. It has an effect against all the other currencies that are traded against the US. How much higher would the US dollar index have been in the lack of that intervention? So this is, we're looking at interest rates. Where are they going to stop? We're looking at inflation. When is it going to peak? We also got to look at this US dollar story as well and say, what is this going to break? And is the US dollar going to break before this breaks? Here's the thing. The US dollar is probably not going to break until we see that the Fed is at the top of its cycle. So 3.25, we think the Fed is going higher. The US dollar index is going to go higher until the Fed starts doing this. At that point, the US dollar index may begin to fall. But until then, it's going to continue to rise. So I don't know that there's much value in betting too much against the US dollar right now. The Mexican peso still holding up, even though the US dollar is gaining strength. The peso is not losing against it. The peso is quite impressive. Okay, let's get set up for earnings. And this is This Week in Earnings. Again, all my links for everything I use are in the description box. Here is earnings estimates. We see this every single time going into a quarter, and once earnings start being reported, up we go. We saw that for the last quarter as well, and we thought, well, Q2 will have a full quarter effect of the Ukraine war, of the higher energy prices, of all that. Higher wages will have that effect in there. That's not going to be good. And it was a record quarter as far as aggregate earnings are concerned. Not dealing with growth in earnings, but as far as aggregate earnings are involved. So, it's not a good trend over time, but we can't. I don't know that I would read anything into it until I start seeing results. Let's go down to page 8. Page 8 will give us our forward 4 quarters in EPS. And there we are. This is page 10 now. Page 10? Yeah, page 10. I thought it was page 8. There it is right there. Forward 4 quarters, 234.39. Last week was 230, but be careful here now. We're now Q4 to Q3. The last time we looked at forward earnings, it still had Q3 2022 to Q2. Now that we're in the third quarter earnings, that has dropped off and we're 1 quarter forward. 234.39 is the forward estimate. The full year for 2022 is 223.34. The full year for 2023 shows growth. That is 7.9% higher. If we are expecting a recession in 2023, which the yield curve being inverted for 95 days now, going on to 100 next week, with rates going higher, with growth in employment slowing down, with PMIs around the world slowing down, with energy prices spiking just before the winter, recession is more likely than not. Are you going to get 7.9% earnings growth from 2022 to 2023 if we expect a recession in 2023? So what we're going to do is take this number here of 223.34 for 2022, and we're going to cut it by 10%. which would be the same as cutting this by almost 20%. And we'll see average multiples in recessions are as low as, well, I've seen them as low as 12, but we'll say we can go down to like 14 and maybe as high as 16 in a recession. So somewhere in between there with those lowered numbers. Let's see what kind of price targets we get to. In the meantime, let's see who is confessing this week. Pepsi on Wednesday. Expected 183 versus 179, so they're expected to show growth. As of Wednesday, we get PPI in the morning. They're reporting at 8:30. We get PPI in the morning as well, and we get the Fed minutes that afternoon. And we only have one earnings report before the Fed minute. The next morning, we get CPI at 8:30. And the next morning, all before the bell, you've got Walgreens, BlackRock, Delta, and Domino's. There's one bank in there for BlackRock. I don't know that there's too much exciting going on in the morning. Not enough of a sample to really make anything out of. But 8:30 is CPI. That's all that's going to matter. That will set the tone. It is a make or break for the bottom of the market on Wednesday. Either we're going to preserve the bottom and find our way back to 37, 37.50, maybe 38, or the bottom is gone. And I don't mean like a 35.50 or 35.40. I mean down to 3,400 before the end of Friday, if that is a bad number. Here is Friday, all before the market opens, because, well, it's Friday. Nobody reports after the market. It's just like in university. No one ever schedules a Friday class, right? They want to go home early. They want a long weekend. Citigroup, First Republic, JP Morgan, Morgan Stanley, US Bancorp, Wells Fargo, PNC Financial. So you have all the big banks, JP Morgan, Morgan Stanley, Wells Fargo, Citigroup, four big ones in the morning of October 14th. So if Thursday is ugly and you get guidance from these banks that are all to the downside, yeah, going into the weekend, you'll be begging for the market to close. There'll be blood in the streets if you're long. This is a huge week for risk. So we'll look at a number of trades that we can set up and what the cost of those trades are, because they're pretty much priced into the market, and how we can sort of position ourselves. But that's what this week has. Banks, Fed minutes, CPI. That's really it. Monday and Tuesday, those are free days. You know, those are free periods. Sit in the lunchroom for those 2 days. I don't think much is going on other than positioning and nail biting. Until you get to Wednesday morning, we get PPI. We get our first look at earnings with Pepsi. You get the minutes. There'll be some digestion of the minutes. It does take a while to read the minutes, so you'll get some digestion of the minutes, and then everyone goes home and CPI the next day. Okay, here is a daily chart of SPY going back to beginning of mid-April to where we are. This was Monday. This was Tuesday. By noon on Tuesday, we were already hitting the highs of the day. By noon on Tuesday, we were up 200 points on the index in a day and a half. Implied volatility was down 3% over that day and a half. This kind of thing, I do not believe. If we are going to get a bottom in this environment that we're in now, with Fed raising rates and then holding them at some high level for some extended period of time, you're not going to get this kind of thing going on. That's just not going to happen. Remember, way back, we have all these conversations about what kind of recovery we're going to get. There's a K, there's an L, there's a U, there's a V, all of these different letters of the types of recoveries. We know that these Vs, these are nothing more than short covering rallies. I will know when we're closer to a bottom, because as the market drops, if the market believes that this is done, this is truly over, as the market drops, short interest won't increase, because there'll be little desire to short at those low rates. But last week we went through a bunch of short interest on different ETFs, and we saw the short interest was on SPY was basically 20%, and on some of the other ETFs that we look at were, especially on IYR was 33%, and on a couple other ETFs we were in the 40s, over 40%. Well, that's why you get those sharp bounces and those outsized moves to the upside, because a lot of it is short covering, which is not really fundamental. It's more technical because, well, it's people trying to get out of something, not trying to get into something. So this to me was a signal to sell. See this red line over here that's shading down? That means I have a short position at that price. I have a short position at 377.15. On that day, I sold 380 calls. I had already sold 380 calls on another rally at 12.99. They expire. I sold 370 calls, 12.54. Or did I sell more 380 calls? I think at 12.99 I did sell the 380 calls on this rally. Yes, I did. Sorry, I did sell more 380 calls. I sold some 370 calls as well, and I'm short at 377. I went heavily short on that because I just didn't believe it at all, and there we go. And that was a big bet to make in front of a jobs report. Anyways, let's look at where we are. Forward EPS, and again, it's Q4 now. We're not even counting the quarter we're in. That's the results that are showing up. 234.39, the index closed at 36.39.66. It's a forward PE of 15.52. If we make a recession range in between 14 and 16, we're right in that particular range right now. There is 15.52. For fiscal year 22, we haven't seen fourth quarter yet, but the expectation if fourth quarter comes in as expected, we'll end the year at 223.34. Fiscal year 23 is 240.97, which is 7.9% increase in earnings. Now, if you think, well, I don't know that there's enough GDP activity to allow for that kind of increase. It's if we get a 1% net income margin expansion, you can get to 240.97. But we're already as a net income margin as a percentage of GDP is already at a record high. Are we going to get an expansion into a mean reverting series that's already at a record high? And a few weeks back, we looked at what the mean reverting levels in that series would be. The long-term mean reverting level is 6%. We're sitting at 12%. Are we really going to go to 13% with wages increasing the way they have? I don't know that you can get margin expansion. So let's R for recession for fiscal year 2023. Let's say that earnings will fall 10% from where they were in 2022, puts it as 201. Typical range of 14 to 16 is 28.14 to 32.16. And we're at 36.39 right now. The risks are definitely to the downside. Knowing that the Fed is more concerned about the economy, only concerned about the economy, and really only concerned about inflation, not that concerned about employment. Having seen what we saw with the money supply, knowing that the direction for the Fed, the best direction is either flat or restricting the money supply from this point onwards, with balance sheet runoff, higher rates creating tighter credit. We saw the employment wage gains were 5% in the jobs report. 1% margin expansion with no real decline in activity, but just an expansion would get us to 241, would probably get us close to 243. I just don't see it happening. So if I had to bet on something, I'd be betting on the downside more than the upside at this point. If we wanted to take a bet on the index here, remember the CPI is a make or break for the bottom. It comes in light, you're going to get a rally. It comes in heavy, you're going to get a sell-off. I just don't think you're going to get this. Well, direction unknown but high volatility, you buy a straddle. You want to be long volatility, which is you want to be long options, long the call, long the put. And the straddle is direction uncertain. So it's long volatility, direction uncertain, 1 week, October 14th, because you don't want to pay a lot for this, because after it's over, volatility could drop quite significantly. Look at the difference in price: 775 on the put, 454 on the call at 366, and the index finished at 366.25. So the call should already has 25 cents of intrinsic value, and look how much cheaper it is. It's going to cost you $12.29. If you had put this straddle on at the end of the day on Friday, this 1 week straddle would have cost you $12.29, which implies a 3.36% move on the market during this week. So options are pricing in, at least options for Friday expiration on the straddle are pricing in roughly about a 3.5% move on the index. 3.5% move up or 3.5% move down. That's just to hit your break-even points. You'd have to move by more than that to get a return on that straddle. But if you're interested in the straddle, again, as I said, Monday and Tuesday, I mean, you could pretty much say there's no class. I'm just going to hang out in the lunchroom. What you can do is wait till the end of day Tuesday before we get PPI on Wednesday and see where the market is at that point in time. Price out the straddle for the October 14th and figure out what percentage move that implies. This CPI report would not surprise me if you get a 2.5 to 3% move just on the CPI report alone. And if it is hot, yeah, 2.5 to 3% on the downside, I don't think would surprise me. And if it comes in benign, if it comes in lower than expectations, yeah, I think you could rally quite significantly off of that. So you can price out the straddle and see what it gets you. If you are long any particular stocks and you're worried about a sell-off, and not so much at the index level, it doesn't work well at the index level when you have volatility that is really skewed. It doesn't work out very well. But individual stocks tend to have volatility that is more balanced. You tend to get a smile more often on that. Is you could set up collars. So if you're long a stock going into Wednesday and you have I'd say, take your 2 or 3 biggest positions if they have options, set up a costless collar. And to do that, if you're long, what you're going to do is you're going to sell a call up here, and you're going to use that to buy a put down here. And you're going to hopefully set it up so that they're the same price. So that means it costs you nothing. So if the market drops, your put will really do well for you. If the market increases, well, you'll make some money up to the call, but then it'll be called away at that price. So it's a way of selling at a higher price. You can set up some cashless collars on that sense, but you will need margin for your put. You're buying your put. You're selling the call, which is covered, and you're buying the put. No margin required. No margin. So it is costless in a number of ways to get that done. Depends on what you want to do. I'm particularly not going to be playing it that way because I'm already short. I'm going to feel the market on Monday and Tuesday. For what I do and how I do it, I don't know what I'm going to do at this point. I need the market to tell me what it wants to do. If you get a 200-point sell-off into Tuesday night before any of the data comes out, I would then be saying, I believe it's mostly priced in. I'd be selling puts. You get a 200-point rally ahead of it, I would say, okay, this is ridiculous. You don't know what the number is going to be, and you've priced in perfection here. You've priced in a good report. The risk is to the downside. I would be selling calls. So a lot of what I'll do is going to be dictated by what the market is going to do. What could help on Monday for markets is China was closed last week. China opens up. They start trading again tonight. If they pop, if they go up and increase from here, that could spill over into other markets. That optimism could spill over. But this is where we are now. My best ideas are, sit on your hands. If you don't know what's going on, sit on your hands. Let the market tell you Monday and Tuesday what kind of positioning that you want. I don't know that Monday and Tuesday is worth adding any new long positions at all unless you have really big sell-offs that are for no other reason than anticipation of something bad. So if it prices in all the bad stuff, then I can see taking long positions, but I don't know if it'll do that. And that's the big thing. That's the great thing about this, right? We play the right side of the chart. We're playing this way. Well, you can't draw lines on that part of the chart. You don't have any Fibonacci retracements on that part of the chart. There are no Elliott waves on that part of the chart. When you look backwards, everything looks neat and tidy. But when you look forwards, you're looking into the abyss and there's nothing there. So you have to use your best experience, your best intuition, your best knowledge, bring it all together. And yeah, that's what we're doing here. Let's look at what our calendar ahead is going to bring us. Okay, October 10th, Monday. 2 Fed speakers. Canadian market is closed if you're on the Canadian side. October 11th, you've got 2 more Fed speakers. Nothing much exciting happening there. Once we get into Wednesday, mortgage applications, but we get it. We know what's going on. I don't think we have to keep looking every single week. I don't think anything exciting is happening in the housing sector at this point until something exciting happens. So I'm probably not going to mention it very often, only because, well, it's down for the count, and there's, we know what's going on. There's really nothing interesting moving. PPI coming out. It's, I think, fallen for the last 2 months. Let's see if it falls again. It's not as important as PPI, but, it does have some impact. Then you have 2 more Fed speakers on Wednesday, and you have the FOMC minutes. And then you're done with the Fed speakers. They got it all out of the way before the CPI report. So I think that they're probably going to come out talking down any potential good news that could come out, and talking tough all week so that when the good news does come out, we still have those words echoing in our ears that, hey, even if it comes in good, we need to see 6 months in a row. So even if this is a good number, well, you still got 5 more that you have to get through. It'll be something along those lines. FOMC minutes, that'll be a big one. That'll dictate how Wednesday is going to close. So if you're interested in saying, well, inflation really is going to set up the bottom, the make or break bottom, and you think that a straddle is an interesting thing to do, going into 4 o'clock on Wednesday night, you might want to set up the straddle, but the implied volatility will already be in there. It'll already be in the price, which means you want to calculate what the implied move is by looking at, well, what does a straddle cost me, and divide that by where the index is, and that will give you an idea of, well, for SPY, if you're doing it on SPY, take the straddle divided by the price of SPY. That'll tell you the implied move. 8:30 on Thursday, you have your inflation read. The very next day, the banks report. So I don't think any bank wanted to share the stage with core inflation. BlackRock is, but all the big banks said, well, listen, let's do it the day after there. Continuing jobless claims, let's see what that, initial jobless claims. I don't think this is, even if this came in higher, I don't think that's going to change very much at all. I think the market is going to be set based on this. The core inflation, this is what they want to see, comes in below 6.5%. That's going to be good. Year over year, I don't really care about. It's the core that we're concerned about. And more importantly, the month over month core. Not so much the year over year, the month over month. So if it comes in at 0.4, that's good. 0.6, that's bad. And then going into Friday, you're going to get retail sales, Michigan consumer sentiment, which are 2 economic reports, but most of it is going to happen. Well, this is 8:30. This is pretty much the banks start reporting at 7 all the way to 8:30, and we saw that we have 5 or 6 major banks reporting that morning. That's going to be pretty much the breakfast for the day. I don't know that retail sales will change much, and I don't know that consumer sentiment will change much. So basically, big ones: FOMC minutes Wednesday afternoon at 2, CPI 8:30 the next morning, and Friday morning before the market opens, all the banks. That's it. There is a, the growing question I keep hearing out there is, where do you hide? With all of this going on, where do you hide? And, the answer tends to be, well, if you need to hide, the only safe place to hide now is in money market funds. Buy a 1 year and you're getting 4.425%. If you're going to be in equities, there is no place to hide. If the market's going down, everything's going down. There is no place to hide. So asking the question, well, where do you hide in equities, is not the right question. The right question is, how do you hide? I have long positions, as I've said before, and I manage my exposure at the macro level with how much positive or negative dollar delta beta exposure I happen to have. If you're not using any options, you can drop the delta and it's just dollar beta exposure. How much dollar beta exposure do you have? Right now, I think I have net negative exposure, so I am positioned more for a sell-off, but that's how you hide. Not where you hide, but how you hide is a better question to ask. Because listen, some people have to be in equities. Some funds have to be in equities. You got money flowing into pension funds every week. Some of that gets deployed to equities. So it's not a question of where do I hide in equities. I don't think that that's a useful question, because the answer to that is nowhere. There's nowhere to hide. Either you lose a little or you lose a lot. And if you lose a little, you're going into low beta, safe sectors like healthcare. But on a big sell-off, healthcare is going to sell off as well. So it's not where do I hide, it's how do I hide. And if you can't use the options to get done what you want, to sell parts of the distribution, you're at a significant disadvantage, because if you're taking short positions, there is a borrow fee. So short positions usually have to be held for very short periods of time. You don't want to hold those for long periods of time. You want to use options to get that done. And that'll wrap up this week. For those of you who have access to the Applied series, if you're a subscriber to the Applied series, part 1 of real estate is up, which does a very long look at residential real estate. That video's part 1's over 3 hours long already. Part 2 will be up this week. We'll be covering some of the other core areas: retail, office, and industrial. I haven't gotten to the other specialty ones yet, but if the video gets to be too long, more than 3 hours, then there'll be a part 3. There is a lot that I know in real estate that I can put in these videos, so they're going to end up being quite long. Anyways, if you do have access to that, that is up. Part 2 for real estate will be out on Friday. And that's it.